Good morning, hello, and welcome. Are you a student eager to dive into the world of cybersecurity and risk management? Or an industry expert looking to sharpen your knowledge on vendor risk in today's digital ecosystem? Or a curious mind fascinated by how organizations manage trust in a connected world? Then this video is just for you. Join me as we explore the fascinating and crucial world of third party risk management, or also known as TPRM, where security, trust, and accountability converge in the age of outsourcing, cloud, and digital transformation. This is part 2 of the series on TPRM. In part 1, we had covered the context and the drivers. We had discussed and reviewed the checklist that makes TPRM a must have in modern cybersecurity. We'll continue in this journey and we'll break down and demystify key pillars of TPRM, which includes the key components of TPRM framework tailored for digital and operational resilience, the cybersecurity risk commonly posed by third parties from unauthorized access to supply chain attacks, the tools and technologies that empower organizations to assess, monitor, and manage vendors effectively. TPRM, in the context of leading cybersecurity framework like NIST, ISO, Orbit, and more, we will be looking at. We will try to understand the best practices that makes TPRM practical, sustainable, and audit ready. A deep dive into top laws, regulations, guidelines, and framework will be taken. These are the ones which governs TPRM in the BFSI sector, including DORA, RBI, GDPR, and CERT-In. An analytical comparison of TPRM expectation across global standards from FFIEC or COSO ERM will be done. And finally, we'll wrap up with the conclusion that ties everything together, showing how TPRM strengthens trust, compliance, and business resilience. Whether you are learning, building, advising, or managing risk, this video will give you the clarity, structure, and insight you need to understand TPRM from the grounds up. So hit the play button, like and subscribe, and let's dive into the world of third party risk management where every connection counts and every risk can be managed. I welcome you to this part 2. Let's get started. This is your host Savit Vittal Salian. Namaskar. Key components of a TPRM framework in cyber security. First is third party inventory and classification. Start by identifying all your third party vendors and categorizing them based on the criticality and their access to sensitive data and integration with business operations. This classification helps prioritize risk assessment and controls. Do note the important is based on criticality. We discussed this earlier. This definition is crucial to be done at the start. If you have to do it, you have to take few teams on board. One is, of course, the business which requires this third party to come in to provide the services. Then get in your risk management team, your controls team, your cyber security team, information security team, and any team which would play a role. Have a thought, do your brainstorming, and then once you identify the teams that is required to help you with categorizing the criticality for this vendor, is when you put up your table right. This one activity will help you in the long run, because anything and everything, right from prioritizing your budgeting, prioritizing the rating of your incident, prioritizing your exit strategy, prioritizing your support, investment of time, prioritizing your patching and so on as we go in further would be based on correct classification of criticality of your third party. Hence, this step is critical. In simple terms, in any organization, there are many vendors and service provider you work with, such as cloud providers, software supplier, IT support, data processors, consultants, and more. These are your third parties. To manage risk properly, you first need to create a complete inventory, a list of all your third parties. Then you need to classify them based on how much risk they pose to you or your business. Like how much data they'll handle, what type of data they will handle, how critical is their services to your operations, or whether they connect to your system and which systems they would connect to. Think of it as sorting your vendor into high risk, medium risk, low risk categories. So you know which one needs more attention and monitoring. Let's look at a checklist of third party inventory and classification. It starts off with creating the comprehensive vendor list. We discussed this earlier also in last few tables. It's creating a central updated list of vendors, suppliers, and service providers. While the primary team to create this would be your vendor management team, but they can't work on their own. They would need all your help, all the departments involved to feed in and enrich that list. Because it's just not about having the name of your vendor or what services they provide. At the very top, they can get it from the requirement, but they will not be in a position to define the criticality and other finer details. Hence, while the primary team which is should be accountable would be your vendor management team, the responsible party and other parties should also be required to get in their inputs. The recommended approach is to have a workflow in place wherein all of these parties are asked to get their input in before we actually onboard. The next is vendor ownership. It's about identifying which internal department owns or manage each vendor relationship. This is critical and complex. Like we might have a vendor who might support multiple departments. In such case, who owns it? Who would be your relationship manager? This is a strategy which every organization need to build in. Ideally, should be one person per vendor or a combination of vendors who would be your point contact. But then there would be subcontacts. Subcontacts would be department wise, but recommended is to ensure that only one person or one team is speaking to the vendor. If you open up, every department can have a direct interaction with the vendor, you would be opening a floodgate because that would overwhelm the vendor, directly affecting the services they are providing to you. This is generally seen during incident. When things are all gone, that's where you see the situation getting from bad to worse because everyone would be trying to touch base with the vendor would get confused. So having a single point of contact for the vendor and for you within the organization helps. The next is service type tagging, which is categorizing vendor by service type. Now that's a breakup, that's a horizontal and the vertical cut that you would like to make with your vendor categorization. Be sensitive that having too much granularity also doesn't help. So need to have a balance. This is a call which the management and the vendor management team in the organization can take as to how much slicing and dicing they would like to have. Next is note what kind of access each vendor has. Data, system, physical sites and so on and so forth. This should not be different from what you have within your own system. Avoid having two different set of criterias. Try to make it even so that governance is easier or manageable. Next is identifying if vendor handles personal, financial, health or confidential data. Now this is going to be critical because this is not unique for a vendor. This would be your organization definition on the data itself. A data categorization comes from your data management team, which would differentiate or categorize or tag the data on different categories. Now, what categories you are having for within your organization is applicable for your vendor. Avoid trying to go overboard and trying to make personal A, which is internal, and personal B for vendor. In this, it will become unmanageable and not sustainable. Hence, the data tagging should be same for internal staff as well as for the vendor one, so that same rules apply. Criticality rating: tag the vendor as critical, important, non-critical. Now this will come from your when you're creating your ownership and your vendor list. So this should be part of that step itself. Assign a risk level based on the access, sensitivity, and exposure. Now this is something which would be vendor specific, wherein some vendor might not have any access to your internal systems. They might be required to do only certain aspect which doesn't allow them to or require them to log into your system. So those would be at a low maybe. But some would be your developer, an external vendor who's developing critical applications for you and requires access to your internal data. These would be categorized different. The risk levels would be different. Hence, ensure that you understand what this vendor that you have onboarded is supposed to deliver for you, and to deliver it, what are the access that he would need. Hence, in the first place, when you are having this comprehensive vendor list and the vendor ownership, you need not only your vendor management team but the business and all the other critical teams to come in and pitch in. Because if you make a mistake there, you might definitely have a such case wherein a vendor is marked low where it should have been medium, and worse, you have marked it low but the vendor has access to a great number of assets within your organization, including your customer data, and it's marked low whereas it should have been high or critical. So this is something which is required to be done, and this can only be done if your first two step on the vendor listing and the ownership is done properly. Regulatory impact: note if the vendor is involved in regulatory functions and with whether their function touches aspects in regulatory aspects, which is rules and regulation defined in GDPR, HIPAA, RBI, PCI, and so on and so forth. Fourth party awareness: check if the vendor outsources part of their work, creating additional risk. So this is something which is not done well in many, if not all, of the organizations. This is not done because it is difficult, it requires effort, and it is more of a check in the box activity, but this causes you grief at worst kind when the systems are down or caused by a party supporting your vendor. Hence, take your time out of your activity and focus on very clear investigation and review with your vendor to know what are the vendors who are supporting your vendors. Review and update frequency: set regular review intervals to keep inventory and classification up to date. We discussed this earlier in the past checklist. Next is due diligence and onboarding risk assessments. Before onboarding a vendor, organization must conduct rigorous due diligence. This involves evaluating the vendor's information security posture, data protection measures, their regulatory compliances, business continuity, and disaster recovery capabilities. Due diligence questionnaires and evidence reviews are commonly used tools during this process. In simple language, before you start working with a new vendor or service provider or third party as we call it, you need to make sure they are trustworthy and secure. This is called due diligence. Basically, doing a background check to understand their risk. You check things like, do they protect their data properly? Do they follow any security standards, or do they have a security standard in place? Have they had any data breaches before? Are they financially stable? Will they follow the rules and regulation you are subjected to? This onboarding risk assessment helps you decide if you should work with them, what conditions or security controls to put in place, or if they are too risky to engage. Now, do note, this is all to ensure you are not bringing a vendor in which can cause you harm. Your primary aim of getting a vendor on board is to help you grow, is to help you support your business, not to add problems. You want to get solutions out of the vendor, not adding to your problems. Hence, as mentioned, we have to look at their information security posture. First of all, check out whether they understand even what information security postures are. When you have this conversation, it will give you a good view whether the organization that you are shaking your hands with do have maturity in this space. Because if they don't have maturity, it's a big red flag. How are they going to protect your assets? What's their wisdom in information security? Because eventually, when they're running the show for you, at least a part of it, without this knowledge, how are they going to support you? What are the data protection measures? Now, do note, one way to do a testing with these vendors are asking them to provide their information security posture. Do not go by giving your information security posture. Your idea is first to check if the vendor is knowing what they are doing. Ask for the information, their information security posture. Ask for their data protection measures. Ask for what regulatory compliance they follow. Ask for their continuity, business continuity and disaster recovery plans. If they are able to provide you all of these, review them carefully to understand their maturity. Now, if any of your vendor is asking you to give it so that they can align, it's a big red flag. Primarily, it could be worst case scenario where they are not aware of what this means in the first place. Such case, back out. But if they are able to provide you, and every good vendor would have this in place if they are in this business for long, then you have a good start. Doesn't mean that you agree. You review what they are giving you carefully. Then try to see whether their posture and your posture aligns at what percentage. 100% fit? Rare. But just try to figure out what is the gap if there are any. So, if there are gaps in their posture compared to yours, that's where you engage and agree as to how that is going to get filled in before you sign your agreement. It is very important that you have this understanding, a clear understanding of this before you even sign the agreement. Do note, there would be extreme pressure from your business to get them quickly onboarded. But let the business know getting onboarding is one, and getting their support in the long run for the business is going to be challenging if these are not in place. Is the business then will come and beat you up if you are a vendor management team? Why didn't you do a check? So, have a matured conversation first with your internal team, the business. Ideally, the vendor management team should have this very clearly articulated and defined in your process, so that a business, when they reach out to you or a vendor management team to get a vendor onboarded, they are very clear what the expectations are from the organization. So they are not surprised. Keeping it transparent helps all. So this is a mandatory, potentially one-time activity. Yes, there would be situations where you have to do a review, but that's an annual review or half-yearly review just to ensure that they are in compliance. Sometimes everything looks okay on paper, good when you start off, but then you realize the organization has drifted, the vendor has drifted in its policies, and you are not even aware. Hence, periodic check, at least once in 6 months to once in a year, is required to be done. And if you are having a monthly vendor engagement, any drift should be articulated by the vendor to you so that you know there is a deviation. Let's look at the checklist. Company background. Check their business registration, history, ownership, and reputation. Now, this is purely on vendor management team to do this part. They are specialized in this. Financial stability. Assess their financial health to ensure they can deliver in the long term. Now, this has been a key area recent. Many organizations going belly up and putting the other organizations in trouble. Hence, having a clear line of sight on the financial health of the vendor is critical today, and keeping a close watch on how they are performing. Review their security policies, access control, encryption, and incident responses. Now, this will require the SME from your side to review the vendor. You have to bring in your teams who manage your security policy within the organization to review how the vendor security policies are and if they are in line or not in line or what is the deviation. You bring in your identity and access management team experts into this conversation to review the vendor's access control process and procedures. You bring in your specialist in encryption space and look at the model, the structure, the architecture of the vendor who would be providing you with the service and how are they in terms of encryption. Bring in your incident management team to review the incident management process of your vendor. Now, do note how many teams are required in this conversation. It's just not your vendor management team. Vendor management team will require all of these teams to come in, pitch in, bring in their expertise. Check if they comply with relevant standards. Now, this is where your risk management team and your regulatory teams would need to be pulled in to review if the vendor is aligned, whether they are aware of, and if they are and they are aligned, check out the current systems, processes against the required one and see what is the gap. Now, all of these places, whether it is security policies, access control, encryption, incident response, or the standards, there would be gaps in all of them, some of them, few of them. The idea here is not to reject. The idea here is to figure out what is the vendor planning to do to get this gap fixed before the agreements are signed. If things can be done before the agreements are signed, fantastic. But if not, check out how much time is committed by the vendor to get all of these in line. Then review with your risk management team, your vendor management team, your business to see if something is acceptable that we onboard and then within this time they would get aligned, and what would be the penalty if they don't, because guess what, if they are not, you would be penalized anyway by your regulators. So you have to cover it. You have to ensure that all the checks and balances are in place, all the nuts are tight, so that you don't have issues later on. Ensure you have requested for their security certification or third party audit report. Most organizations would have their own internal audits, whether it is from a third party themselves or their own internal audit team. Ask for the reports. Check out their compliance status. This gives you some form of an assurance as to what the vendor levels are in terms of compliance. Understand how they collect, store, protect sensitive data or personal data, because the data belongs to you. It's your data. The sensitivity assigned to the data is your sensitivity. The personal data is your personal data. Hence, the moment it moves from your area to the vendor, you need to understand how are they going to ensure it's protected. It doesn't get leaked or lost, because you are accountable for it. Next is ask if they rely on any other vendor, fourth party, and how they manage their risk. Next is ensure their willingness to sign data protection agreement and security clause. This is mandatory, making them aware the losses you would potentially incur if there is a breach. And if that breach is caused by the vendor, It is recommended to have your contracts designed such a way that the penalties are easily transferable to the vendor and the vendor is aware of it. This would increase the cost for sure, but then look at the loss that you would incur. From a reputational perspective, the reputation is yours, not the vendor's. The legal cost, the penalties and fines, the tangible ones can be transitioned to the vendor, but what about the reputation, the intangible? Hence, while the intangible is belongs to you and can't transfer it, the tangible ones make it a point to have it documented in your contract so that the vendor is aware you lose $1,000,000 that comes from their pocket. So that's how contracts has to be negotiated. Check out if the vendor is ready for it. Many would not even qualify for it. Having said that, check their business continuity plan and disaster recovery plan. Bring in your continuity and disaster recovery teams to review the vendor's process and policies. Document the vendor risk score and final onboarding decisions. Do note this decision has to be signed off, agreed by the business first. The business has to sign off post understanding all the risk associated with it. If there is a deviation, if there is a workaround, the business has to sign to it that they agree to this workaround. They agree to this deficiency. They agree to the risk associated with the gaps that was identified in the pre-assessment. The reason being, during actual service issues, the business is the first one to kick rest of the teams as to why this was not thought through. Hence, it is important the business understands what they are signing for. If all the checks and balances are in place and the business is signing and later it is found it is not so, then the business would have a higher ground, which is rightly so, that they checked everything is in place. But there were gaps which is missing, which is more of not visible during the assessment. That's understandable. But if the business is signing on a risk, signing on the gaps, then the business loses that moral authority to question anyone else because they knew what they were signing into. Hence, boarding the decision is required. Next is contractual safeguards. Contracts should clearly define the security responsibilities of both parties. The access limitations that would be enforced on the vendor, the service level agreements, the incident notification timelines, the right to audit, how data handling would be done, the protocols associated with it, and of course the termination clause. In simple language, when your company hires a third party vendor, you both sign a contract. This contract should not just talk about pricing and timelines, it must also include clear rules to protect your data, your systems, and possible to an extent your reputation. These contractual safeguards makes sure the vendor is able to handle your data securely. They are able to follow laws and industry standards. It makes sure the vendor tells you immediately if something goes wrong, like a data breach. It allows audits and reviews. The vendor has backup plans in case of failures. The vendor deletes or returns your data when the contract ends. In simple terms, it is about putting security and trust on paper. So everyone is protected and knows their responsibilities. From a checklist perspective, specify how data must be handled, stored, encrypted, and who can access it. We discussed this in the earlier slides. Ensure parties agree to keep sensitive information private to an extent required by the law, and it is mutually agreed but dictated by the company to the vendor. State that the vendor must comply with the laws and the standards, at least all that you as an organization are required to. Define the minimum cyber security measure the vendor must maintain. Now, for this specific case, this minimum standard is your organization's security policy. The baseline, the engineering guidelines on cyber security that you as an organization are following, it's a minimum that the vendor should also be following. Now, this is something before you sign the agreement, because some guidelines might be tough for a vendor to implement. In such cases, you need to know. It's not a case where you get surprised post signing off, too late in the game. Set deadlines for notifying you in case of a data breach or security incident. This deadline should be lower than your own internal deadline. Why lower? Because you might require some time to review what the notification is on the data breaches, review, analyze, and then take a call to inform your stakeholders. And that would be hard coded, which means your internal sign off with your regulators and your internal stakeholders says 60 minutes. You don't want a vendor to come in and tell you about the data breach in 59th minute. We are left 1 minute to take all the review and take a decision. Too late in the game. Hence, if you need time to review, say 15 minutes to 20 minutes, you have to set your vendor timelines to 30 minutes. So, in case of a data breach, they should inform you within 30 minutes. Once you get the information, you take a call, review it, analyze the pros and cons and the risk associated, so that you can consolidate and inform your businesses and in case regulators as you have committed to. No regulator would take it kindly if you have missed the agreed timelines. Hence, setting the deadline is not back to back. It is your agreement minus a number, and then that's the number that you give to your vendor, and it will be lower than yours. Next is give the company the right to audit or assess the vendor security control. Now, right to audit is a mandatory thing that should be in place. If a vendor refuses, it's a strict no, back out, because you don't know what the vendor is doing, and you will never know it if you don't have an audit clause within it. Subcontract condition, require the vendor to seek approval before using any subcontractors, the fourth party. Now, two parts here. One is when you onboard a vendor, check out whether the vendor provides the service themselves or they take it from someone else. In such cases, you will do all your due diligence, not just for your vendor but for your fourth vendor. But once a vendor is onboarded, and then that vendor later on wants to bring in a new vendor to support it, this is only possible if there is a pre-agreement to this. And one of the clauses that should be made mandatory to your vendor is any vendor that requires to be onboarded need to follow all the required guidelines that your primary vendor is supposed to follow. And before the vendor is onboarded, the fourth party vendor is onboarded, all the assessment done by your vendor need to be reviewed by the primary, which is you, your organization. And if you deem fit that this vendor is requiring additional scrutiny from you, then that should be in the clause that you will go to the sub vendor directly or through this vendor and do your own audit. An audit clause should not be just limited to your primary vendor. An audit clause should be cascading to the next vendor who's supporting your vendor. So basically, you are putting it clearly to your vendor that any new vendor that they bring in would be subjected to all the clauses, including a direct audit. This is generally not done because it's an overhead. But this Might look like an overhead, but it is something which is crucial during running your operations. Hence, it's an effort, but it's worth the effort. Next is including expectation on uptime, disaster recovery, and continuity planning. So, all of these would be in line with yours minus a percentage or a time. So, if your uptime is 30 minutes, you can't have a 30 minutes uptime from a vendor. It should be lower than that. It could be anything from 25, 20, or 15, because you would require certain time to recover your own internal process. Your disaster recovery, if it is 2 hours, 1 hour, 30 minutes, depending on your systems, the vendor can't have those. It should be lower than yours. Similarly, if that vendor is being supported by any other vendor, a fourth party, these should get lower and lower. Because for what matters to you is your customer and the commitment that you have with your customer and your stakeholders and your regulators. Termination and date of return. Classify how data will be returned or deleted at the end of the relationship. Now, this clause will also flow to your fourth party or fifth parties if there are. And you need to have those additional clauses inserted. Liabilities and insurance. Define who is responsible for losses and require cyber insurance coverage. Have a thought on not just your vendor but on your fourth party if there are any, which would be borne by your vendor. While you will not manage the insurance for your fourth parties, but you have to ensure that you are adequately protected. Ongoing monitoring and risk assessment. Third party risk is not static. Regular assessment through periodic questionnaires, external threat intelligence, penetration testing, or audits are necessary. Risk levels should be reassessed upon changes like scope expansion, data volume increase, or any regulatory shifts. In simple language, it means once a third party vendor is approved and onboarded, the job isn't done. Risk can change over time. So, you need to keep checking that the vendor is still secure, reliable, and compliant with what was agreed with, or is compliant to your current requirement. This process is called ongoing monitoring and risk assessment. It helps you catch problems early, like change in the vendor's security postures or change in any new regulations, incidents, or any business change. A vendor could be acquired by a new vendor or a different organization, or your vendor is taking over a new organization, hence there might be change in its characters. You need to know that. Hence, ongoing monitoring is key. Think of it like regular health checkup for your vendor in this case. You don't just trust them once. You keep checking in to make sure nothing risky has changed. From a checklist perspective, let's go through few and you can build on it. One is monitor if the vendor is meeting service level agreement and expectation. Do note, making it monthly is the best, if not quarterly, rare cases, maybe half yearly, and definitely not annual. Understand that there's an overhead in having it at a lower frequency, but if you think from a time that you would invest in your monthly, compare it with the time that you would invest in your half yearly, I think it would be more or less the same, but much higher control. So the recommended is to keep it at a low frequency monthly, maybe at a department level, but no compromise on the checklist. The department level will also do the same high level scrutiny month on month. Set periodic assessment or survey to confirm ongoing security practices. The recommended is to have a clear checklist in place, agreed early on with the vendor. Of course, you have the final say to add new things to them. But if a checklist is given to a vendor and a vendor is able to populate it and bring it to the table in your monthly review, that would bring down the time that you invest in this review, but you'll get all that you are looking out for. So, security questionnaire is a best practice that's recommended for every vendor engagement. Track if the vendor had experienced new data breaches or security incident. Make this a point in your monthly review. Ensure continued compliance with changing laws like GDPR, DORA, or RBI guidelines, or any guidelines that you are required to be compliant with. The idea here is to have these inserted into your checklist, and the vendor is aware that he has to fill and populate it every time before the meeting, so that any exceptions can be discussed. Things which are in compliance can be reviewed later on, but exceptions is what can be reviewed, agreed, and then a decision can be taken. And it's transparent, fair on both the parties. Where possible, use tools to track vendor cybersecurity scores. This is bringing your cybersecurity team or your internal security team in your monthly reviews. Request updated audit reports. If there has been regular audits by the vendor, vendor has committed that he would conduct independent of your own review, you expect that the vendor is giving you those reports. Document it, agree with it upfront. Reassess if the vendor merges, get acquired, changes services or location. Now this is a big red flag. Maybe nothing comes out of it, but the point here is you have to know as an organization that these have happened, and you can do your independent review. How does that change the posture of your risk? Hence, business changes are required to be informed formally and well agreed in advance. Update the vendor's risk category if their exposure level increases or decreases. This you can know very easily in your monthly meetings. Check if the vendor is following the terms agreed in the contract. Generally, they would. But if not, you should be in a position to flag it out, track it, figure out what caused it. Is it a one-off or a systematic failure? Why it has failed? Is there a structural changes, negligence, or any other thing which would have caused it? Hence, your monthly meetings helps. Confirm the vendor's preparedness to respond to incident and notify you promptly. And this can be reviewed for any deviations in your review meetings. So this is the top level checklist. You can build on this a more detailed one the way you deem fit for your organization. Next is incident response and contingency planning. Organizations must establish joint incident response protocol with key vendors, clear escalation paths, communication framework, and simulation exercise ensure preparedness in case of a breach or outage. In simple terms, even the best vendor can have problems like data breaches, cyber attacks, or system failure. Hence, if something goes wrong, your business must respond quickly and reduce the damage. That's where incident response and contingency planning comes in. In TPRM, it means making sure vendor knows how to report the issue fast. The definition of a fast is the definition that you would have given the vendor. And your definition would be dependent on your commitment to your internal stakeholders, external stakeholders, regulators. So everything has to be tied in and factored in. Ensuring there is a clear plan on how your company and the vendor will handle the incident is key here. In TPRM, it also means preparing backups or alternative solutions to keep your business running. It's like having a fire drill. You don't want the emergency, but you need to be ready if it happens. A case in point, supposing from a network perspective, your organization is connected across multiple branches, across geographies, onto the net, onto your private cloud, and so on. To manage it, you might have few major vendors, telco providers. But that telco provider in turn would require sub providers or the local telecom infrastructure from local companies and organizations to support it. So it's just important as managing your vendor, but also the sub vendor. While the sub vendor would be managed by your vendor, it's important for you to know how it is done. How are they ensuring that the sub vendor might not vanish away during critical time? So it is important to ensure there are escalation paths within your primary and your secondary and your tertiary vendors. So you are not held up in a black box. The framework of communication should be clearly articulated. More importantly, the simulation exercise required to be done. This could be your DR drill. But what is the depth of your DR drill? That is something where people miss out or organization miss out. You might have an excellent DR drill within your organization, but the vendor might not be able to meet up 100%. They might be able to do it for 80% of it. What's that 20% gap? But the tragedy happens when the vendor, sub vendor, is only able to meet 50% of it. Effectively, while your is 100%, because the sub vendor is able to meet 50%, your overall effectiveness is only 50%. But this visibility comes only as a surprise. Something which could have been avoided if due diligence was done initially before onboarding. Now, this is a scenario which you need to bring it upfront with the business in case the business is forcing you to get the vendor onboarded quickly. Making the business aware of these finer detail and aspects of incident response and contingency planning helps the business to know why we are doing what we are doing. Now, from a checklist perspective, the first is ensuring vendor notifies you quickly within the defined hours of an incident. Defined hour by you. Ensure that all the contact lists are updated, both your teams and the vendor incident team. Make it a point, this is reviewed every month if there is a change. Any deviations need to come up upfront and recorded into your central database. Contact lists and things are required during incident management process. Hence, your incident management database needs to be updated every time there is a change, and this comes from your service review meetings. And if it is done on a monthly basis, it gets updated there and then. Just think through, your contacts have changed and you only come to know in 6 months. You lost full 6 months, and in between there have been an incident, no one would know whom to call. This is the benefit of having a review meeting at a lower frequency, namely monthly. The root cause analysis. It requires the vendor to investigate the issue and share a clear report on what went wrong. An RCA is critical. Now, while the vendor can do their RCA, it's recommended you drive the RCA. It's your business which got impacted. Hence, your incident management team, your problem management team, your RCA team should have the authority to pull in the vendor for the work. So it is not hearsay, it is not via information, it is a direct feed. And RCA is critical so that no future occurrences occur, which is a repeat of the earlier incident. Agree on how your team and your vendor will coordinate and respond to incidents. This is where you would have challenges if you are not clear. We would, during an incident, everyone would like to know the source. We would like to speak to the person on the ground. And it's chaos. Because everyone wants to get an update. But the person who is actually working would not have time to update because he is working. And worst case scenario is instead of fixing the issue, he is 90% or more time coming into a call to give an update. So you don't want that situation either. Hence, ensure you understand the difference between the person who is fixing the issue and person who is updating the issue. And have it clear documented as to who will come into a call and who will not. Because the last thing you want is everyone is updating but no one is working on the ground, or at least the right persons are not on the ground fixing the issue. This is your incident response plan. This is an important part only a proper BAU guy and a person who is doing a firefighting understands. A firefighting team has two components. One, the team which is putting off the fire, and second, who is updating what is happening. You don't want to mix that role. Define how and what will be communicated internally and what would be externally. Internally is the vendor's point contact, your point contact. Externally will always be you. You don't want a vendor to update to the external stakeholders. All stakeholders talk to you and you talk to the vendor. The moment you get your vendor talk to your external stakeholder, which in case could be a regulator, you might have serious trouble because information might not be filtered, creating panic, which you don't want at a situation when you're already in trouble. Regulatory reporting. Make sure the vendor helps you meet the breach reporting obligation and the communication happens only through you. Have a workaround or backup ready in case the vendor system goes down. So what it means is, yes, you have a vendor to support you. Yes, you have a vendor who will take care of your systems of resiliency and backup and things. But what if the vendor itself gets knocked off? Do you have a plan in place? This is not vendor management. This is your own internal backup plan, independent of the vendor, which you have to test it. So what can be tested, what cannot be tested is something that should be very clearly articulated. That is, considering the vendor is not there today, from now, what you will do. That's your contingency measure. So one with the vendor, one without the vendor. These two are two distinct document and processes. Do not mix this. Check if the vendor tests their recovery plan. Now this is a place where you will drive it. You would chair it. The vendor would drive it, but you would chair it. You have to know how it is done, what is done. You have to see upfront as to what's working, what's not working. Where is the gap in line with what your expectations are or requirements are. Conduct simulated incident response drill. The vendor would have their own comprehensive, excellent drills, but it's of no use if you don't know what it is. So, when a drill has been performed, insist and make it mandatory that you are there as an observer. Make it mandatory, keep it documented, get your business heads to participate into it, because this is all for that business head. The business should know what they are paying for, and business should know what they are supposed to get or expect to get from a vendor. You don't want a business to be surprised later on. Post incident review. After an incident, review what worked, what didn't work, update the plan. Part of your RCA. A critical piece of your RCA. Next is termination and offboarding controls. When the vendor relationship ends, secure offboarding process such as data destruction, access revocation, and contractual closure help mitigate any residual risk. In simple terms, it means when your relationship with a vendor ends, whether due to contract expiry or performance issue or a business decision, you need to offboard them safely. This is called termination and offboarding of TRM or in TRM. If offboarding is not handled properly, the vendor might still have access to your data or system. The vendor might still have copies of your sensitive information. A vendor might have access to user accounts and credentials that weren't deactivated. This creates serious security, privacy, and compliance risk. That's why every offboarding must follow a clear, secure process to protect your data and your systems. From a checklist perspective, you need to immediately remove vendor access to systems, network, shared drives, and tools. While it's easier said than done, why it is difficult? Because how would you know what systems are they having access to? What networks they have access to? What drives are shared? And what tools are they currently using that belongs to you? Why it is difficult? Because if you have no processes in place to track this when you provided them, there is no way you will be able to know what to revoke. This is one topic which I discussed in my earlier slides. Do visit that. If you do not have a system while the contract was in force to track how or what systems were given access to, if you don't have a process on what request was made by the vendor and what was fulfilled and what was not, you would not know it when it is time to terminate. So, what it means is the best practice is the way you would provide access to your internal stakeholders, the process that you would follow for your internal stakeholders would be the same process for your vendor, maybe with higher controls. Now, if you are an organization where you don't have a process for your internal, then God save me. You need to have that, otherwise, you will end up having some serious risk around this place. A major breach is writing on the wall if you don't have a process to manage or to find out what access was given. Next is deleting user account, password, VPN access, API token associated with the vendor. All of these are easy wins provided the way you provisioned is tracked and you have a system in place. If you do not have a system in place, rest assured you would have missed an account, you would have missed a password, you would have missed one, few, or many VPN access, you have missed a lot of tokens. So, before we even go to this vendor management, you need to have your own internal processes around this space. Tight enough that you would know every account that was created by whoever, inside or outside, is listed and tracked and has a document associated with it. Ensure all sensitive data is returned or securely deleted with return confirmation. Now, it's not that you're going to take a paper and ask them to sign off. This should be process driven, and only process driven can help you ensure that you are completely wiped out what is not required. Make sure the vendor's subcontractor, if any, also removes your data and access. Now, this is going to be messier because if you don't have your own process, what is that you are going to control with the vendor, and there is hardly going to be any control with the sub vendor. So, fix your house first, get your process in place, then get the vendor onboarded onto the process, and a subcontractor also need to get onboarded. So it flows from top to bottom. Check for any open issues. unresolved incident or access log before closure. This is useful if you are having your monthly reviews in place. Use formal exit checklist and get sign off from relevant teams. Very similar to what you have as an exit checklist for a staff or a system for your organization internally, you need to have same and with a higher control when you are dealing with a vendor. Officially close the contract, resolving any outstanding obligation or penalty. This is where your legal team and your vendor management team will come into play. They have the role, primarily they will the one who will play this role. If needed, ensure a smooth handover or work of systems to new vendor or team. Now this is going to be difficult if you have no process document or work document in place. If you have it, then it's a straightforward with a finer handover of more of what's active on the plate. But if it is not in place, then it's a nightmare. So getting your documentation right in every aspect, in every form and shape helps with this knowledge transfer aspect. Do note, once you decide a vendor is not required or need to terminate, the support from the vendor would degrade. In some cases, simply not there. In order to avoid that situation, and the right way to do it is, the moment a vendor is onboarded, have everything documented. When I say everything, literally every aspect of it, no matter how small it is, get it documented, signed off, reviewed by the business, of course, and by any technical team that is associated with the support. Mark the vendor as terminated and archive related documentation, something which the vendor management team and the legal team will require to be doing. Conduct a security audit to confirm all access point and data trails are closed. This is an aspect which is not mandatory in most organization, but if done, it need not be an audit team. It can be an internal risk team, departmental team, controls team, or combination of that. But if it is an audit team, it would be best because it's a professional help that you will get. An independent review, dispassionate, and can look at every aspect of it from possible angles that can harm the bank. So they can check from those aspects and give you a sign off. It gives you a sense of assurance. This concludes the third part, which is the key components. We looked at the key components and covered the checklist. Hence, in part 1, we covered the context and the drivers. And in this part, we completed the key components. We'll conclude this part 2 now and move to part 3 for other topics. I would like to thank you all for investing the time in this. Thank you very much. See you in part 3. This is your host, Savit Vittal Salian. Namaskar.